Ever wondered how insurance companies always seem to make money, even when paying out big claims? Well, today we will discuss about the world of insurance to uncover the secrets behind their business model. We'll break down exactly how these companies operate, explore their revenue streams, and highlight some real-world examples of how they continue to thrive in a world full of risks. Before we dive into how insurance companies make money, let's first get a basic understanding of what insurance is and how it functions. Insurance companies sell policies that provide financial protection in the case of specific losses, such as damage to property, accidents, or health issues. Policyholders pay a premium, which is the regular payment to the insurance company in exchange for coverage. If the policyholder experiences a covered event, the insurance company pays out claims to compensate for the losses. The fundamental principle here is risk pooling. Many people pay into the system, but only a small percentage file claims at any given time, creating a system that allows insurers to collect more in premiums than they pay out in claims. The most obvious way insurance companies make money is through premium collection. Let's break down how premiums are set and why they're crucial to the company's profitability. Insurers rely on data and statistics to assess risk and set premium rates. They analyze factors like age, health, driving records, and location to calculate the likelihood of a claim being made. Premiums are designed to cover potential claims, administrative costs, and ensure a margin for profit. Insurance companies classify risks into different categories. Low-risk customers typically pay lower premiums, while high-risk customers pay more. This calculated pricing model helps insurers collect enough premiums to cover their overall claims expenses while making a profit on top. However, collecting premiums is just the beginning. Insurance companies don't let that money sit idle, they invest it to generate additional income. Insurers typically invest the premiums they collect in a mix of stocks, bonds, and real estate. This is known as the float, the money they have on hand before paying claims. The returns on these investments provide a major revenue stream. Even when claims are paid, insurers can often earn a substantial profit from the interest, dividends, or appreciation of their investments. For example, life insurance companies often invest in long-term, low-risk assets, as they anticipate holding premiums for many years. Investment income is one of the reasons insurers can stay profitable even when claim payouts are high. Further, collecting premiums and making investments is one part of the story. Insurance companies also have to carefully manage costs to stay profitable. Loss ratio is a key metric for insurers, representing the percentage of premiums paid out in claims. A lower loss ratio indicates greater profitability. Companies work hard to maintain a low loss ratio by using underwriting, which is the process of evaluating risk before issuing a policy. Insurers also focus on reducing administrative costs, including overhead, employee salaries, marketing, and technology infrastructure. Efficient operations lead to better profit margins. By tightly controlling these costs, insurers can maximize the gap between the premiums they collect and the money they spend on claims and operations. One of the most important ways insurance companies manage their risk exposure is through something called reinsurance. But what exactly does that mean? Reinsurance is insurance for insurance companies. It allows them to spread the risk of large claims by purchasing coverage from another insurer called the reinsurer. By transferring some of their risk, companies can protect themselves from massive financial losses, such as those that might occur during natural disasters or widespread health crises. Reinsurers typically operate on a global scale, spreading risk across different regions and sectors. This risk-sharing mechanism helps insurance companies maintain financial stability and continue generating profits even in times of unexpected catastrophes. In addition to premiums and investments, insurance companies have several other ways to generate income, often from less obvious sources. First is service fees. Some policies include extra fees for things like policy changes, administrative services, or processing. Late payment penalties. Insurance companies often charge fees when policyholders miss a payment deadline. Third is cancellation fees. Some policies include cancellation fees if a customer decides to terminate their policy early. These additional charges may seem small, but they can add up to a significant source of revenue for large insurers. Now let's take a look at a real-world example. We'll use Geico, one of the largest car insurance companies in the US, to see how they apply these strategies. How Geico maximizes profits. Geico offered competitive premium plans to the buyers. Geico uses extensive data analysis to offer competitive premiums while still maintaining a profitable risk pool. Next, Geico generates massive investment income. Geico's parent company, Berkshire Hathaway, is famous for its investment prowess. using the company's float to generate additional income. Additionally, Geico's efficient operations has minimized administrative costs by embracing direct-to-consumer sales via online platforms, cutting out the need for middlemen like brokers. Moreover, Geico uses impressive risk management strategy. Geico utilizes reinsurance and careful underwriting to limit its exposure to high-risk drivers. Geico's success story showcases how all these components come together to create a highly profitable insurance company. Now, many people wonder how insurance companies can be so profitable while also paying out millions or even billions in claims. Let's break down how they navigate this delicate balance. Insurers have to ensure that their claims-to-premium ratio stays in check. If too many claims are paid out relative to premiums collected, the company will lose money. To maintain profitability, insurers aim for a combined ratio, claims plus operating expenses, under 100%. A ratio under 100% means they're making money, while a ratio over 100% indicates losses. By carefully balancing claims payouts, investments, and risk management strategies, companies can pay out big claims without significantly impacting their bottom line. This balance allows insurers to make profits in most years, even when faced with large, unexpected claims. Conclusively, insurance companies have mastered the art of balancing risk and reward. By collecting premiums, investing wisely, controlling costs, and managing risks through reinsurance, they're able to turn a profit year after year. Even though they're in the business of paying out claims, these strategies ensure they remain financially sound and profitable in the long run.